Hello and welcome to this session in which we will discuss revenue recognition, specifically step 4 in the revenue recognition. In step 4, we are going to allocate the price to the separate performance obligation. In the prior 3 recordings, first we discussed what is a contract, why is a contract important. Then we identified the separate performance obligations in the contract. Then we determined the transaction price in the prior recording. In this recording, we're going to take the transaction price that we allocated in step 3 and allocate it to the separate performance obligation that we determined in step 2. So it's very important, if you haven't viewed 1, 2, and 3, step 1, 2, and 3 in revenue recognition, please do so in the prior recording. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So this is basically step 4 of 5. We still have 1 step to go. Now, how do we allocate this price to the separate performance obligation? Once again, if we have only one obligation, that's pretty straightforward. If we have more than one separate performance obligation, we're going to be using the relative fair value of each goods and service. Now, what is the relative fair values? If you looked at my property, plant, and equipment chapter, if you looked at my inventory chapter, the relative fair value is a simple, straightforward concept that you need to understand, which we would look at today. But first, I want to make sure you understand this relative fair value. Let's assume you walked into a Burger King and you ordered a meal number 62. I don't know. I've just made it up. Okay, and the price for this meal is $7. And in this meal, you're going to get a drink, you're going to get the fries, and you're going to get a burger. So you're going to be getting 3 different items: the soda, the fries, and the burger. And the deal is you pay $7 for all 3 items if you buy them all together in a meal. Now, what happened is this. When Burger King gets the $7, how much of the $7 is allocated to the soda, how much is allocated to the fries, and how much is allocated to the burger? What Burger King would have to do is find the fair value of each item separately, because they do sell the soda separately, they do sell the fries separately if you wanna buy them, and they do sell the burger separately. So here's what we're gonna do. We're gonna assume the burger is worth $5 if you wanna buy it separately. The fries are $2.50. And the soda, I'm going to make it $2.50 as well. So the fair value, if you want to buy each item separately, this meal it will cost you $10 if you buy them separately. Well, what you do now is you find the relative fair value of the soda, which is $2.50 divided by 10, is 25% of the deal. The fries also 25%, and the burger represent 50% of the deal. Now we can determine how much of the $7 to allocate to the soda. Well, let's start with the burger. The burger, it's 50%. So we're going to say the burger we're going to allocate $3.50. For the other 2 items, if we take $7 times 25%, we're going to allocate $1.75 to the fries and $1.75 to the soda. And this way we allocated the $7 to all 3 items. Now, again, I used the simple, straightforward example, but the concept is the same, whether you are dealing with software installation, complex robotics, or any other contract. You would use the relative fair value, and hopefully you were able to pick up the concept here. Now, what is fair value? Now, which is okay, fair value is what the company could sell the goods or the service on a standalone basis. And in this example, pretty straightforward. If you want to go in Burger King and buy a burger by itself, they have a price for it, as well as the fries, as well as the soda. But the question is, what if the fair value standalone basis is not available? What if that's not available? What if you're selling a unique product, or a product that's very dissimilar of any other product that doesn't have a fair value? What do we have to do under those circumstances? So if the fair value standalone basis is not available, we have several options to determine the fair value. We can use something called the adjusted market assessment approach. We can use the expected cost plus a margin approach,
or we can use the residual approach. So what I'm going to do, I'm going to go over each section and explain it briefly. So this way you understand that if the fair value is not available, the company will have other options. What is the adjusted market assessment approach? Basically, you can evaluate how much the market is willing to pay for those goods and services. You just have to make basically a study, look at different things. What do you think the market pays for this? What is the fair value? Okay. Now, you could also refer, if the competitors have similar product, you can refer to their prices and adjust as necessary. You know, maybe if they are operating in a different location, they might be selling the product at a different price. If they are offering warranties or no warranties, so you could look at your competitors, and this is called the adjusted market assessment. So you look at what the market is willing to pay for that product with certain adjustments. Or you can use the expected cost plus a margin approach. You would say, okay, how much this item would cost me, plus what will be a reasonable margin, or what would I charge for a margin, and this will be my fair value. That's another way to figure out fair value if the fair value is not there. The third approach is the residual approach, and here if there is no standalone exist or uncertain, if the standalone does not exist or uncertain, it means you don't know what the fair market value is. Here's what you would do. You will take a look at the total transaction price, and you will deduct any observable prices. Now, observable prices, they can be reached from this approach, the expected cost plus a margin, or from the adjusted market assessment, and whatever is left. And hopefully it'll be one item's left, and that item, whatever that item is, it's called the residual price. You would allocate to it the residual price. So if you are selling 3 items, 1, 2, and 3, and the contract price for the sake of illustration is $1,000. The first item, there's a fair value for it, and that first item, the fair value is $400. The second item, also there's a fair value for it, and the fair value is $500. Now the third item, we don't know what the fair value is. It's so unique. Well, guess what? If they paid $1,000, well, the third item must be, using a residual approach, is $100. This is what the residual approach is. So those are basically techniques in case fair value don't exist. So the companies have options in determining the fair value.
Let's take a look at this example to illustrate the concept. Ryan sold a robot that can perform labor work in warehouses called the Brad X. Ryan sold the robot inclusive of installation and training. Now bear in mind, the installation does not require proprietary information about the robots. So simply put, Ryan's objective from this sale is to sell the equipment. The other services, installation and training, can be performed by other parties if necessary. Why are we saying this? We want to emphasize that selling the equipment, installation and training are 3 separate performance obligations. So Adam purchased the robot for a price of $450, and Ryan chose Ryan to do the installation. Ryan charges the same price irrespective whether it does the installation or not, because their objective is to sell the equipment. The installation service, if someone hires Ryan for an installation work, he will charge them $20,000. Also, Adam contracted Ryan for training services. Also, the standalone price is $25,000. Now, Adam is obligated to pay Ryan $450 upon the delivery and installation of the robots. Ryan delivered the robot and completed the installation on November 1st, X1. Training related to the robots starts once installation is completed and lasts for 6-month period. So what do we have here? Well, we have 3 separate obligations. We have the selling of the equipment, the installation, and the training. So what we need to do, we need to figure out the standalone price for each, which is the equipment $450, the standalone price for the installation $200, and the training is $25. All 3, they have a total of $495,000. Now we find the relative weight for each, taken $450 divided by $495, which will give us 90.90% of the deal goes for the equipment. $20,000 divided by $495, 4.05% of the deal toward installation, and $25,000 divided by $495, the training represent 5.05. Now what we do is we take the $450 times the related percentages, and this is how much we allocate to the equipment, this is how much we allocate to the installation, and this is how much we allocate to the training, which is $409.50 for the equipment, $18,225 for the installation, and for the training $22,725. Again, what are we assuming here? We're assuming we have 3 separate obligations, because the equipment can be sold separately than the installation. The installation can be sold separately. It has a standalone price, and the training as well can be sold alone and separately. Now let's take a look at the journal entry that takes place on November 1st. We debit cash for $450. Ryan debits cash for $450. Credit service installation, because the installation has been earned, installed it, $18,225. We credit revenue for that. We credit unearned revenue, which is a liability for the training, because we have not earned the training yet. We earned the training as we perform the work. And we credit sales revenue $409 for the sale of the equipment. So we have a service revenue contract for $18,225, a sales revenue, and unearned revenue. Now, December 31st, 20x1, remember the training is for 6-month period. What's going to happen after 2 months? We are going to take $22,725 divided by 6, then multiplied by 2, and for this period, for the 2 months, November and December, we are going to earn $7,575 out of the $22,725. So we debit unearned revenue, reduce this revenue, and start to recognize the revenue. Now we're gonna go through January, February, March, and April, and we earn the full $22,000 by April of 20x2. What should you do now? You want to go to Farhat Lectures and reinforce this concept by working MCQs to help you get ready, whether you are studying for your intermediate accounting, CPA exam, or CMA exam. In the next lesson, we would look at step 5, which is allocating the price in a revenue recognition. Invest in yourself. Revenue recognition is an important concept in accounting. Good luck, study hard, and of course, stay safe.